Well, good morning. Welcome to the. Good morning. Welcome to this meeting of the Pensions Committee. I am obliged to inform you that this meeting is being live streamed and recorded. Members of the public will be able to view the meeting using the link on the agenda. The first item is apologies and submissions. We have not received any apology. Well, we have actually. We've received an apology from Byron Cook, who unfortunately has gone down with COVID. He's recovering from that. And we've also received an apology from Terry Tobin of Grants Thornton in one of our items. I'd also at this point just like to particularly welcome a new non-voting member, one of our employee representatives to the committee, and that is Lindsay Short, who is replacing Laura Hoskinson. So welcome to you, Lindsay. Moving on to disclosable interests. Are there any disclosable interests, please, members? Ready?
Chair, I'm not sure if it doesn't apply this part of the meeting, sorry.
Okay, thank you. Minutes of the previous meeting, we've all had those provided to us. Are we happy that they are a true and correct record? Carolyn.
Just a couple of points under the minute for section 48. The sort of second lot of bullet points on page 4. There was quite a discussion on the second bullet where we talk about short and medium term plans, and Councillor Roger Evans talked about 2025. My recollection was that there was quite a specific point made about the need to set those short term and medium term targets, and that short term was sort of 18 months to sort of 2 years. And so I just wonder if we can just reflect that, because I think that's really important that we are committed to those short term. We don't lose sight of what short term actually means.
Okay. I think we will be sort of revisiting
we'll come back
later on in the
and then there was just one more around the 6th bullet point in terms of the engagement with employers. That I do recall making the point that engagement had been limited in terms of being able to be written out to employers. It'd been over the summer when many of the schools who were in our scheme are not available, and we'd only had 2 respondents. So again, I just think we need to make sure we don't lose sight of the fact that we only had 2 respondents to that, rather than give the impression that we've done a wide ranging consultation.
Okay, well, thank you for that. Everybody happy with the minutes? Yes, Simon.
Yeah, I'm just following on from what Councillor Healy was saying. I did bring up the issue of how you actually measure carbon, and there was a discussion. It does come up later on whether it's the release in an absolute terms or a terms with regard to increased growth. And I think Alan had always focused on as a percentage vis-a-vis increased growth, and I did feel that we ought to be measuring absolute terms. And that's not in the minutes.
Okay,
but we do pick that up.
We do pick this up later,
Chair. So we'll,
yeah. Okay. Well, do make a point of bringing
I will.
Yeah, okay. So may I have I'll move the minutes and can I have a second, please? Brian, all those in favour? Yep. Okay. Thank you very much. We'll now move on to public questions. We have 2 public questions. Neither of the questioners are actually physically present today, so I'll ask Justin to read out both questions and James to reply. So over now, basically, I think we're Justin, you're reading both questions together, and then there is a single, because the questions are very similar in context. There will be one reply from James to cover off both questions. So over to you, please, to read out the 2 questions, please, Justin.
Thank you, Chair. The first question is from Mr. Paul Cooper. I speak as a Shropshire County Pension Fund pensioner who cares about my retirement income, but who is increasingly concerned about the coming suffering of all of us, and especially my children and grandchild, not to mention the suffering already being heaped onto our brothers and sisters in hotter regions of our earth. Last year, already a year ago, Sir David King, the government's Chief Scientific Advisor 2000 to 2007, Fellow of the Royal Society and Officer of the French Legion d'Honneur, in recognition of his work on the climate challenge, said that what we do in the next 3 to 4 years will determine the future of humanity, meaning that we must urgently slash our dependency on fossil fuels and rapidly transition to renewable energy. So 1, do you accept what Sir David King says? 2, if so, is the pension fund's engagement strategy framed to achieve transition to renewables by 2025? 3, if not, will you immediately reframe your engagement strategy to achieve a 2025 cut-off point from investing in fossil fuels? Please do not refer me to previous discussions and decisions, as the situation is getting more desperate day by day.
Thank you. And the second question, please.
Second question is from Mrs. Chris Welsh. A recent FOI viewable on What Do They Know website lists BMO SCPF milestones achieved last year. Depressing to see how many consist of reports: 2050, 2060 targets, advisory votes, etc. One element of the FOI not answered was how much carbon reduction has been achieved by each milestone, and since each was not answered, I assume the answer is none. I appreciate the value of engagement, and the attempts being made are excellent. If we had all the time in the world, but we don't. Read the latest IPCC report. Sir David King has said that we do have what we do in the next 3 or 4 years will determine the fate of humanity. Engagement with fossil fuel industry has been going on for decades, and their response is millions into greenwashing and business as usual. A recent peer-reviewed article analysed 12 years of data to determine if BP, Shell, ExxonMobil and Chevron are decarbonising and shifting to clean energy. The article headlined that there is a mismatch between discourse, pledges, actions and investments, and concludes that no major is currently on track to a clean energy transition. Clearly, actions aren't matching promises and commitments. It's greenwashing. Have the committee councillors who consider that engagement is working scrutinise Shropshire County Pension Fund's quarterly engagement records? Will they examine the FOI data and read the report reference? Do they believe the warning from Sir David King, or prefer to believe that we still have 3 more decades left to publish reports and make commitments?
Okay, thank you. And the response, please.
Thank you, Chair. The response is, we agree with Sir David King's assessment that the next few years are vital for climate action, and the paper's findings that oil majors still have a long way to go before they are fully aligned to a 1.5 degrees Celsius world. They are closer today, however, than at any point previously, and momentum for the energy transition is building steadily. Comparing the current climate stances of the 4 companies mentioned in the report and many of their peers with those of 3 years ago also reveals the scale of change made, in no small part due to the pressure and engagement from investors. Whilst the precise carbon reductions from each milestone cannot be calculated, when viewed in full, they demonstrate the strategic changes many high carbon companies are starting to make. Actions like setting long-term targets, assessing the robustness of business models in a 1.5 degrees Celsius world, or disclosing if corporate lobbying efforts are supportive of the Paris Agreement will contribute to companies starting to make the changes required to decarbonise and play a role in the energy transition. For example, events like investors voting to replace a quarter of ExxonMobil's board with directors supportive of the energy transition at the 2021 AGM may not reduce carbon in and of themselves. The impact within the company and sector cannot be underestimated. For the first time, the company has now set long-term carbon targets and allocated capital to low carbon spending. It has much more to do, but things have started to turn, and we see signs of increasing momentum across the sector. Our primary measure of progress, though, is of course reductions in carbon emissions. The significant progress made over the last few years on climate change could be viewed as groundwork, finally getting companies to accept the need to transition, to set targets, and to acknowledge the risks climate change possesses. The next few years, as Sir David King says, are crucial. The long-term ambitions have been set. Now companies must match rhetoric with action. Decarbonisation plans must be improved and implemented, and we must see genuine emissions reductions. This is the focus of engagement now, pushing companies to cut absolute emissions before 2030, to cut fossil fuel production and demonstrate real progress. Thank you, Chair.
Thank you very much for that. And I think I'm right in saying the questions and answers are published on our website. Yeah. We'll now move on to the next item, which is a report from Grant Thornton. Terry Tobin, as I said earlier, has given his apologies, and Grant Patterson is kindly going to take us through the report, informing us about the audit risk assessment for the pension fund. So welcome, Grant, and over to you, please.
Thank you, Chair. So yes, in front of you today you've got one paper from us which links into our planning for the 2021-22 audit of the pension fund accounts. Just to keep members informed, our work on planning is on track, but I'm just not quite in a position yet to release a full audit plan to the committee, which we'll release to the next pensions committee. But this document in front of you helps inform that planning process. I'm sure members of the committee who've been on here before have seen something similar in previous years. I'm not going to talk through it page by page, but essentially it summarises the sort of two-way communications we're required under auditing standards to have with yourselves. And we've discussed this with officers, and they provided responses to the questions that we've posed for this year. We're comfortable with the responses from officers. So effectively what I'm asking for you as pension committee is to have read the report and confirm that you're consistent, that the responses are consistent with your knowledge and understanding of the fund, or there's nothing else that you wish to bring to our attention. So it covers those areas of sort of law and regulations, governance, but there's also the bit at the back around accounting estimates. So I wasn't going to go through it in that detail. It is more of a conversation with yourselves about, is there anything in here that you're uncomfortable with, and if you have confirmation that you are comfortable with, then happy to take questions on the paper itself.
Okay, thank you very much for that. Members, Brian, you've got a question.
Yeah, yes, if I can take you to page 10 of your report, Grant. It's our page 18, page 10 of the report. No areas with a high risk of material fraud have been identified. Can you describe what would material fraud look like? At what level do we classify a fraud as material?
I'll start, Chair. I mean, in terms of that, I suppose in the way, actually, it's interesting you raise that, because auditing standards are changing. For this year, currently, our assessment materiality is what, I suppose, a material error or fraud error in your accounts would be in relation to how we set our overall materiality, which is what 1% of the net assets. So it will be, on a 2 billion fund, around 20 million, etc. So, I mean, that's where we're looking at the moment. I think you will see this evolving into the next year, where I think there's a greater sort of expectation on auditors to look for or to design their approaches around fraud. Now, clearly, I think for members of the scheme, they might consider, in their personal circumstances, a level of fraud to be significantly less than that. But really, what we're looking at, I suppose, in terms of the accounts, is do they present a true and fair view, and given the level of assets of the pension fund, how far out would they need to be before we think someone might be misled as a result of a fraud or error. So at the moment we set that as our materiality, which is 1% of your net assets at the year end. You may well have a lower tolerance for that, and you may design systems in a different way. But from an auditing perspective, that's where we sit at the moment.
I'm just coming in there. I would hope very much we do have a much lower tolerance.
A material fraud of 20 million would take some doing.
You might say that, Jan. In terms of that, I mean, certainly the fund does take. I mean, traditionally, I suppose, where you've seen in the past frauds in pension funds is around. I don't know, your administration team will be over this. Would be maybe people with pensions dying, and then maybe relatives continuing to receive the pension, etc. Is one area. Or I mean, I suppose in the way what we're looking at here is when we look at fraud at the pension fund. I think that picks up on Brian's point is probably around theft, if you know what I mean, in terms of could someone misdirect an investment somewhere to that level around treasury management controls. And traditionally, when we've looked at those design controls around that, we haven't identified that. And we're clearly, as part of our audit, we do sample test transactions, etc. So I think, yes, I mean, if had to be here, you're looking probably at could someone misdirect any investments coming into the fund? Could someone redirect contributions, etc.? You have quite strong budgetary controls, and we always get a report from you on an annual basis around differences. So you do have a control system that should hopefully pick this up. But yes, there may well be fraud at a lower level in terms of overall transactions. But I suppose in the way we're focusing on that in terms of what we consider to be those material fraud aspects.
Okay, thanks, guys. Any other questions? No. Yeah, it's Caroline.
Just out of interest, have we ever had any instance of fraud that have been uncovered through the audit? Just a shaking head.
No.
Okay.
So I think we as a committee are happy with the process. So please carry on, Grant. Yes.
Yes, thank you, Joe. We'll come back with a full plan and talk you through that once it's completed and discussed with officers.
Okay. Well, thank you very much for that update. Thank you. We'll now move on to the next item, which is an update on the Task Force on Climate-Related Financial Disclosure, TCFD, and this Patrick O'Hara and Laura Mitchie from LGPS Central will be taking us through this particular item. We have a members, I think we've got a presentation of the back of our copies, back of our agendas. So over to you, please, Patrick and Laura. Thank you.
Yeah, thank you very much for another opportunity to come and speak to you. Sorry, Laura, the cut in there. Laura's going to take you through the first bit of the presentation, which talks about TCFD and what we're doing around procuring an ESG tool to further enhance our reporting to you and the other partner funds and some of the other initiatives we're working on at the moment. And then I'll give you an update on our work on implementation of net zero and the position that LGPS Central has taken on Russia. Over to you, Laura.
Thanks. So good morning, everyone. Thanks for having us here. So as Patrick said, we've got quite a packed agenda. I'm going to start off with the TCFD report. So this is not part of the slide deck that we sent across. It's actual, I'm going to be referring to the actual TCFD report. And afterwards, we'll be covering a number of topics through the slides. So this is the second annual TCFD report produced by Shropshire. And just to give a really quick recap of what the TCFD is. So the TCFD has become something of a global standard for how organisations, and that includes pension funds, insurers, banks, and just companies, report on their approach to managing climate risk. So the TCFD recommendations cover four kind of main pillars, those being governance, strategy, risk management, and metrics and targets. So the TCFD is essentially a condensed version of the climate risk report that we produced for Shropshire, and that was reviewed by the committee several months back, I believe. So then also in addition, this report is relatively similar to the previous years. There aren't many changes. So the focus of this kind of update will just be focusing on those main changes that have happened. So if we just begin with the governance pillar, and if you can go to page 7 of the report. So the main change here really is the incorporation of the fund's climate strategy. So Shropshire's climate strategy has been referenced throughout the report. And the governance arrangements around kind of the climate strategy and the climate risk management of the fund. So for example, we've included things like the climate strategy review process, so who reviews the strategy. The timelines have also been included, so how often is the strategy reviewed, and then also things like the high level beliefs of the strategy and the fund's beliefs on climate change. So these have all been incorporated into this section of the this section of the TCFD report. And apart from that, really, the governance sections have remained the same. There haven't been massive governance changes year on year at Shropshire. If we move on to the strategy section, which is on page 9 of the report, there have been some changes in terms of the inclusion of climate risks. So there has been an expansion to include the fund's belief on climate-related transition and physical risks. And then also we have the climate scenario analysis, which was very briefly referenced earlier. So with this, we completed the climate scenario analysis about 2 years ago now, and this is an exercise that is done every 2 to 3 years. So given this, the results are the same from the previous TCFD report. However, we did receive a lot of feedback regarding a 1.5 degree scenario, and Shropshire do really want to include this, so we're doing a lot of work on this. Our provider has now got a 1.5 degree scenario that we can use for climate scenario analysis. So that will be included in the kind of next climate risk report and therefore be included into the next TCFD report. So it hasn't been included this time, but it's something that will be forthcoming over the next year. So on the next kind of recommended disclosure on same page actually. So we've kind of included some impacts on the climate related risks and how those are managed by the fund as well. So these are actually taken from the climate strategy. So again, it's just an update really. And these include things like making regular measurements of how climate risks are measured, using a variety of tools, how the fund does that, and the integration of climate considerations into things like due diligence, engagement and voting. And secondly, we've also made some specific reference to the fund's equity changes. So these have just gone through, but they're not going to be in this TCFD report, given that it's from the previous climate risk report. But we have made reference to the passive fund being transitioned into a low carbon net zero aligned benchmark, which is expected to result in around 70% reduction in the carbon footprint and 7% annual reduction thereafter in the passive fund carbon footprint, which, like I said, the transition has now happened. And the other big change really is the UK equity portfolio being transitioned into the Global Sustainable Fund, which we also foresee having a downward impact on the carbon footprint.
Laura, can I just pause you there? Just because I noticed one of the members highlighted in the minutes the point about short-term plans. And I think it's just really worth highlighting that those short-term plans were actually agreed at the last committee meeting, and as such having a very meaningful change in our equity allocation and the carbon exposure thereof.
Chairman.
Yes, Roger. Thank you.
If I can, apologies for being a few minutes late, but on page 9, in long term, I see you've got extreme weather events, and in your definition for long term is that we expect these risks to principally cause impacts 10 years and beyond. Could I suggest that extreme weather is here short and medium term? So should that not be brought forward? And I see the definition between short and medium. It would be good to see some separation between the two, but certainly long term extreme weather events, I don't think it'd be 10 years.
Carolyn.
Yeah, just in terms of the sort of short-term actions that we discussed at last meeting was the transfer of the passive fund, wasn't it? So that's one action, and I think we ought to be more ambitious than that, given the serious nature and the this is an emergency, and we really do have to take quite severe action more quickly. So I think I'd like us to explore more than just that one action, and I think we tick the box. Thank you.
Sorry, I'll just clarify, there was two actions. There was the legal and general, which was about 60% of our equity assets. There was also the UK equity going towards a sustainable equity fund, which is specifically targeting companies that aid in the green transition, as well as contribute to one or more of the UN social development goals. So that's actually about 70% of our equity exposure we are moving. And I think Patrick and the team are going to come on to some of the next steps beyond that.
That's great. I'm just asking for more ambition.
And what I would say as well is just that I would expect the next iteration of the climate scenario analysis model to do a better job of modelling physical risks and the shorter term impacts that I agree we are seeing now. I think the 10-year horizon there is a product of the model that we used 2 years ago, being devised a couple of years before that. These models are pretty sophisticated. They take quite a lot of work to update them and change them. So that's probably why you saw longer dated physical risks mentioned in the earlier iteration of the report.
Perfect. Thank you, everyone. Yeah, so if we just cover that off and move on to the risk management section, and just to note, there have been no other changes to the strategy and the governance sections. And really the main change in the risk management section now is that we have featured the company names of Shropshire's climate stewardship plan. So these have been made public, but they were also made public through the public climate risk report as well. So this has just been one other update. And then on the metrics and target sections, there have been a few changes. Obviously, we've updated the carbon risk metrics, the data there, and we've given some year-on-year comparisons as well. But you'll be familiar with all this data because we went through it in quite detail with the climate risk report, but we've just reflected that there. And the other kind of major change in this whole report is that we've made reference throughout to Shropshire's net zero commitment. So yeah, those have really been just kind of the major changes. I'm happy to take any questions, but we're also happy to move on to the slide deck if you would like.
Any questions? Ray? Yeah.
Well, it's kind of building on Carolyn's point, and I know there's been an acknowledgement that we'll have 1.5 degrees in the scenarios. But can we have them in there throughout? There's a couple of tables as well, which only go up to 2 degrees. I think, talking about ambition, we should be seeing one degree and 1.5 degrees, and the modelling around that as well. So I would request that those are in. And Carolyn and I were talking about this, whether it's necessary to put 4 degrees in there, apart from to show how bad it really could be. I'm not sure.
Okay. Simon, yes.
Yeah, I was looking at the table on page 56. That's the PAC table, the electronic PAC. The benchmark. Where does this benchmark come from? What exactly is the benchmark that we are comparing the portfolio against?
Yeah, absolutely. So 56, that's the big table, isn't it? So I'm just trying to get.
I don't know if we're doing good or we're doing bad, because there's a benchmark which I don't know.
Yes, so the benchmark is the same as you would for the investment. So for the global equities, it would be, I think, the FTSE All World, I believe, and then for the total equities would be a blended benchmark. So it would really be dependent what benchmarks you use for your portfolios.
Yeah, now I understand what a benchmark is, and I understand if I'm looking at the FTSE index and what investment return you're supposed to be making, but I don't understand in the context of a carbon footprint what the benchmark is. Who's created that benchmark? It's not the FTSE benchmark, or is it some other bodies? I just don't know.
Yeah, those benchmarks are the performance benchmarks there, and they represent the investable universe for the mandate. So that would have been agreed when the mandate was set up, and we, as your manager, set up mandates that partner funds want to invest in, and that's part of the asset allocation decision: what market you want to get exposure to, and what return you're looking to achieve through that. Now, the reason we carbon footprint the benchmark and compare it to the portfolio is that in many respects, it gives a relative view on how much risk exposure the portfolio is carrying compared to the benchmark. It's also an indication of how well the ESG policies and processes of the investment managers are working, in that we would expect to see a manager with strong ESG credentials and expertise to be having a much lower carbon intensity than the underlying benchmark. And the reason it's good to know is that if we assume that one of the risks associated with climate change and the transition to a lower carbon economy will be a carbon price, and we try and consider what the impact of that carbon price will be on the benchmark, we know that the portfolio, if it has a lower carbon intensity, and absolute emissions is another way of measuring this, will be less exposed to that risk than the benchmark is. So that's one reason why on carbon intensity metrics, a benchmark to the underlying comparison to the underlying performance benchmark was a relevant comparison to make. Now, there are other benchmarks that you can use. You could compare it to some kind of green tech benchmark or some other tilted benchmark if you wanted to understand have a different view of relative performance. But all of the underlying benchmarks, they have to be paid for to get that data, and so there is a cost associated with making those sort of comparisons.
I'm sorry, that doesn't help at all.
No.
Can I step in? I think the total global equities benchmark, which is the vast majority of your equities are global equities. I think it's about 90% of your equities are global equities. The benchmark is FTSE All World, which is just the universe of investable publicly listed companies in globally. That's the key benchmark. The total equities has about 10% roughly in UK equities, which the benchmark is FTSE All Share. So I think that the blended benchmark will be 90% FTSE All World, 10% FTSE All Share, very roughly speaking.
All right, well, look, why don't you just walk me through the top line then? Total equities carbon footprint. And I have a portfolio and the number is 146.8. I don't know what that means. Against a benchmark of 169.1. And then we say in 2020 we're doing well because the footprint is 13% lower. But I just still don't understand where you pull out that benchmark from. What does it mean? Whose benchmark?
How is it come?
Well, that is the benchmark that the performance of that fund is measured against. So it's when that mandate was set up, it was decided by us and with the contribution from the partner funds that was the market you wanted to have exposure to. That was the benchmark, and that was the investable universe. So that's how we've compared the carbon performance of the portfolio to the underlying benchmark that you're measuring investment performance against.
Major, are you asking how is the benchmark actually calculated? Is that the question you're asking?
Yes.
In terms of tons of
So I thought that was really clear, James. We have a thing called a benchmark,
yeah,
and we're looking at whether we're doing badly or better than the benchmark in PF for portfolio. It looks, from what I'm hearing, is that we're only talking about performance here as regard to returns. What I'm not hearing is the relevancy of the TCFD.
so we can take you through this in a bit more detail, but the calculation is based on tons of carbon dioxide per $1 million of revenue. So if somebody can just explain a little bit more about how that benchmark is actually calculated, I think that might just help understand what it is that's actually being measured, that we're better than or worse than. I think that's the point they're trying to get to.
Yeah, so Laura, you go ahead with the actual calculation, but it's the weighted average carbon intensity of the benchmark compared to the weighted average carbon intensity of the portfolio and measuring the difference between the two. Laura, do you want to run through the calculation itself?
No, sorry, I get that. I get the calculation. That's not difficult.
Okay.
It's going back to who set the benchmark, and it seems that in some sort of prehistory, there was a mandate agreement that was the benchmark, which I can't see from this what that actually means or relates to. Because if I double it, the benchmark, we look even better. And of course, what is the benchmark?
Right.
So
The other thing that I would wish to know is a performance 13% below benchmark a relatively good performance, or is that abysmal? Where do we stand in relation to performance with many of our contemporary organisations? You could say that we're 13% below benchmark. If the average is 70% below benchmark, we're doing quite well. If most people are outperforming the benchmark, then we have a lot to catch up. I don't really understand.
The benchmark is the average, is the global investable average. That is the benchmark, and it's basically, apart from a slight overweight that the fund has to UK equities, it's basically just the investable universe globally, weighted by size of company.
Okay, thank you.
Okay.
And those companies have to report their carbon emissions. So I'll turn my camera on while talking. Those companies have to report their carbon emissions in their annual report accounts. Then a data provider, I'm not sure what data provider you're using, whether it's FTSE or MSCI, goes through those report accounts, pulls the carbon that they report out, and then measures and then adds it up across all the companies weighted by their size, so that you get a measure for what global equities, the companies that make up the global equity benchmark, are producing in carbon intensity. And then your data provider is doing the same on the funds on the companies you actually own. And at the moment, that is 13% lower than the global universe if you just held the benchmark in line with size. So hopefully that answers how have they calculated where have they got the carbon numbers from. So I'm going to pause there.
I've just got a quick question. Presumably when we see the figures for 2022, the reduction, the benchmark will be whatever the global benchmark is, but because of the transition that we are and have just undertaken, our carbon footprint will be considerably less.
Yeah.
Sort of 7% less. So we're going to see a massive reduction in the 2022 figures.
Yes, you will. And to answer the question about how do you compare to your peers, if a number of your peers have also made that switch, so the people who have made that switch at the moment, you will look worse than. But once that switch is made and you report versus that switch, you'll have done a much bigger improvement and be more in line with your peers. But not all of your peers have, so you're still, not all of your peers have done that. So there will be a mix and match. But after that switch, you will be much more at the vanguard of your peer group.
Okay, thank you. Caroline.
I think that understanding of where we sit in our peer group and alongside other government pension schemes actually be quite helpful, actually, if that's possible, to bring that back. Because I get what you're saying about the global benchmark, but it's understanding, I guess, around similar pension funds to ourselves would be helpful. I mean, I just wanted to sort of come back on a couple of points. So I think Ray is right in terms of, you know, having scenarios of 4 degrees. I mean, it's a bit pointless in some respects, isn't it? Because, you know, the latest IPCC report is very clear. If we get that far, well, you won't have global markets. You know, I mean, this is kind of really serious stuff. I mean, we'll be in a very, you know, we'll be in a societal breakdown position at that point. So I think that, you know, having reporting at 1.5, that's what we're aiming for. So that's what we should be making sure that we're covering that in the scenarios. But I just wanted to raise a couple of points around the engagement examples. I've got just a couple of questions. So one on the Shell example, where it says that LGPS Central voted against the shareholder motion to set a public greenhouse gas emissions reductions. I'd like to just understand why that vote was taken. And then also on the sort of Ryanair example, I mean, that Ryanair haven't set out a plan or a target for net zero, and I guess how long do, you know, if we're trying to engage with these companies, how long do we sustain that position before we decide actually that they're not committed to this agenda at all?
Okay. Laura, do you want to take that, or?
I can begin it. So yeah, absolutely. So with the Shell, and just to flag the Ryanair is with VMO, so I'm really sorry I can't give you much more on that. So just with the Shell, it's very similar to kind of what we've been talking about. We felt that their short and medium term targets weren't, you know, fully aligned. We had some concerns around, you know, their use of carbon capture and storage and their kind of climate strategy as well. Like, how are they going to achieve 1.50? And we just had concerns about their use of forestry offsets as well. I think that was one concern that we raised. I think the gigaton of CO2 that they were going to offset, they would need, I think it was something like the size of Wales, they would need that much land to do. So there was just some concerns about, you know, how is this actually going to be put into practice? And that's why we kind of voted against that. I mean, we've had a meeting just a few days ago again with them, so we are just really actively engaging with them. And yeah, I mean, that's just the really high level why we voted against that. And I think it just shows that, you know, we're not going to, you know, agree until we can see that it's fully 1.5 degree aligned, their strategy. And sorry, Patrick, do you want to take the second part?
Yeah, on the second one, taking the example of Ryanair, obviously it was a BMO stock, but we have an engagement program going on with a number of firms around this. The first escalation point would be to vote against management. So if we feel that management aren't taking this seriously, aren't moving fast enough, aren't being transparent enough with investors, most of those engagements are collaborative. So there's a lot of us together. We have a reasonable size amount of the company held amongst us, and we will vote against management on those factors and report and accounts if we feel that there's not enough going on there. The other thing that we will do is lodge shareholder resolutions, which we've just done with in collaboration with Share Action and a number of other investors to invite you know, additional pressure on the management of a company to act and change course. Now, if that engagement doesn't work and we feel like the company's not transitioning and this becomes, and it will do, a material consideration in the investment case and the valuation of the company, that's when that would become a decision for divestment and sale. Now, as you know, we don't manage this money in-house, so that is a conversation for us to be having with our external managers, but that's why we expect them to have very strong processes in place and commitment to the integration of ESG into their investment processes. And we have challenged them on a number of occasions last year on stocks where we didn't think the engagement program was credible, and that resulted in them selling. And I see that trend being increasing over the next few years as this becomes increasingly significant in terms of the performance of the companies, and our net zero commitments put a framework around our expectations around the decarbonisation of the portfolios.
Carolyn.
Yeah, I mean, I welcome the fact that you don't want to accept, you know, on our behalf, things like carbon capture and offsetting as a way for companies to try to reduce carbon footprint, because clearly that isn't the right strategy. We've got to actually reduce actual carbon emissions. So you know, I understand why I voted against, and I think that's, you know, probably the right thing. However, I suppose it just comes back to this point of if engagement isn't working, at what point do we, and how do we influence that? How do we sort of say, okay, this engagement isn't working, the fund isn't being invested in a way that we as committee members feel comfortable, and so how can we influence, I guess, those decisions? Because what you just described, Patrick, it sounds as, you know, we work through you. You then have, you know, there's a number of layers, isn't there, to get to that, where the funds are invested. And I guess I'm trying to understand what is our influence in terms of making a decision that says this engagement isn't working with this company. It's time to just move our money.
Well, the net zero framework and the net zero approach that we've taken, if we think of it in terms of a carbon budget, so there is a carbon budget for the portfolio managers. We would expect them to use that carbon budget if they deem it appropriate on if to use it at all, that is, to use it on companies that are a part of the solution to the transition to a lower carbon economy, companies that demonstrate an ability to transition and a willingness to transition and to be transparent as investors. Now, if our external managers are incapable of doing that or show an inability to do that, then that questions whether they're the appropriate managers for us to be utilising at all. Now, there is a balance here because we judge them on the performance, the investment performance of the mandates that they're managing. And if we start making decisions on their behalf, that discretion that we've given them, that relationship we have with them, starts to become compromised by that. We'll talk about this a bit later in the presentation, but it is ultimately our money, it is ultimately our mandate, and if they're not delivering on that mandate, it becomes a question as to you know, how we appraise them. Just a point to add that we have the 3-year review of mandates across fixed income and equities coming up now, and the RI team and you know, colleagues across the whole of LGPS Central will be involved in that, and a key part of that is net zero and how they're going to deliver on our net zero expectations. So that's the challenge we've made on a number of occasions with companies, is that if there's a stock in the portfolio, this is why we want to analyse the holdings in a bit more detail through ESG data and tools. We can challenge them on that. We can ask them, how's that got through your ESG process? How are you engaging with this company? How have you prioritised your engagements? And how is it going? And what does this mean for the investment case? And that's how we've challenged them. That's where we've perhaps sharpened their focus on certain stocks. So it is a balance to be struck.
Brian.
I was impressed by the example on your page 14, our page 52 of Glencore. I thought that this example demonstrates why divestment is not necessarily the best policy. Staying invested gives us the opportunity to influence Glencore's policy and gives us the opportunity to influence other policies. We may not be seeing a lot of progress, but if we stay invested, we can gradually build up a consensus of other like-minded investors, or contribute to a consensus of other like-minded what in terms of carbon reduction policies. So I thought the Glencore example was an excellent example of why we ought to stay invested in all these companies listed just above the Glencore example.
Thank you, Roger.
Thank you, Chairman. I note what has just been said, but I will be referring to Glencore in the next paper, and when it talks about Russia, things like that, and what Glencore are doing. And I can't support totally what has just been said, but I will pick that up in the next paper and the presentation, which is included in that.
Okay, thank you.
Just to give you a very quick example on engagement, you've probably seen very recently the announcement by HSBC to remove themselves from financing of coal, and that is following an engagement again organised by Share Action that we were involved in, and we voted and supported resolutions asking them to do that. Whilst banks, they don't have very much emissions themselves, especially their offices, their financed emissions, the emissions associated with the companies they invest and lend to are enormous, and they have enormous influence on the pace of this transition. So, you know, the fact that I don't think HSBC would have done this as soon as they've done it had the investment community not been pushing them as hard as they have been to do it. And we've seen similar stories at other banks, including Barclays. You know, we wrote to 60 odd banks last year asking them to do this. So we're focusing on the supply of fossil fuels, we're focusing on the demand for fossil fuels, and we're focusing on the financing of the fossil fuel industry as well, as part of our engagement programme.
Okay, thanks. Lindsay, did you want to come in?
Yeah, I think that there's just a bit of a problem in that it's hard to get the fossil fuel industry to change its core business, and that no matter how much you engage with them, they're still going to be fossil fuel companies. So kind of at what point to reach net zero will there be divestment?
Yeah, so our position on that is there are certain fossil fuel companies like Exxon and Chevron and others that are clearly unwilling to enter into a meaningful transition. And we don't expect to see those companies in our active portfolios. We don't expect them to be selected as stocks by our managers because we don't think their ESG integration processes would pull them out and find them attractive investment opportunities. There are other companies like such as Shell and Total is another one, although that's got a few issues in Russia at the moment, but we'll put that to one side as we're focusing on climate change right now, that are embracing renewable energy, that are investing heavily in carbon capture and storage. Now, all of the credible scenarios around 1.5 degrees do envisage a contribution from carbon capture and storage. The IEA scenario itself in 2050 predicts a net zero world that does have fossil fuels in the energy mix, but it's where emissions are abated. It's hard to model realistically a 1.5 degree scenario without any fossil fuels in the energy mix and without any contribution from carbon capture and storage. So as owners and responsible owners of these companies, and that's how we regard ourselves, we're not speculators in their share price, we are owners. We are encouraging them along this transition pathway, and we expect them to see that, and we expect that to be accelerated now. So we could try and use whatever influence we can to make sure that management's focus remains on that key transition.
Okay. Thank you very much for that. Now, I'm very aware that Patrick has got to leave us for a hospital appointment in the not too distant future. So what I'm going to suggest is if we've had enough of a debate on this subject, we move on while we've still got Patrick for the next sort of 20-25 minutes, whatever, onto the slide show. Yeah, everybody happy with that? Yeah. So if we could move on then please to the next item. Thanks.
Yeah, absolutely. So we've got you've got the slide deck. And I'm assuming, well, I'm hoping it's fair to assume that you'd like to talk about the short-term and medium-term targets predominantly. So we've got kind of 3 agenda items. We've got the stewardship code, which is just an update on kind of timelines and things. And we've got the ESG data tool, which we're currently in the process of procuring. And then we're coming on to kind of short-term, medium-term targets, which we talked about a little bit already. And then we've also got a slide on Russia. So I'll just go through stewardship code and ESG data tool quite high level. Just ask questions, very happy to, and if you want more information, I'm happy to go into that as well. But I do want to leave time for the short term and medium term target section. So if we just start on page 4, so a recommendation out of the climate risk report was for Shropshire Pension Fund to report against the stewardship code, so the 2020 version. Shropshire is already a signatory to the previous code, however, since then a new code has been issued. And just a little bit about the code, and I think we've talked about this before, it is really a big piece of work. We have now become a signatory and 2 other partner funds have, so it is, you know, it does take several months to complete, and we'll come on to the timeline in a second, but it is doable, so just to flag it is doable. At a high level, the principles cover things like purpose and governance, the investment approach, engagement, and exercising rights and responsibilities. So the major difference between the 2012 and 2020 stewardship code really is it's become more outcomes focused. So the FRC really want to see what the outcomes have been of, say, an engagement. We're talking about engagement right now. They want to see, you know, what were the objectives, give a description of the engagement, and what has the outcome been? You know, has it been successful? If it hasn't, what kind of escalation techniques have you used, and have those been successful? So they really want live examples to showcase that. Shropshire do have a very slight advantage in that the FRC have highlighted areas that were lacking amongst the first cohort of signatories. So there are some lessons to be learned already. The kind of 4 main areas that were highlighted were kind of around market influence, so how Shropshire influences, kind of market perception, reporting outside listed equities, which, you know, outside listed equities with carbon footprinting and ESG in general is slightly more complicated. And as I mentioned, outcomes is also an area that people need to report more on. And then also effective engagement. So there are some great areas that we can take from there and some lessons learned. So just on the next page, on page 5, there are some quite tight rules on what we are allowed to produce for Shropshire. So the FRC have been quite stringent on what level of assistance we're able to give to partner funds and yourselves. But there are some, or quite a few areas we're able to provide narratives on. So in total, we're able to provide narratives on around 8 of the 12 principles, and these include things like engagement activities and outcomes from us and our engagement provider EOS. We can provide examples of kind of escalation of engagements and what that has led to. We can also provide things like critical votes and voting outcomes. So there's quite a lot of info we can give you there. In addition, your kind of external managers as well. So and BMO as well, so your engagement overlay will also be providing narratives. So you've got kind of a lot of info coming your way, and so it really is manageable, and I'm sure you've got a lot of info from the first stewardship code as well that you can use. So just on page 6, we've kind of produced a timeline just to see how this would actually be implemented in practice. So the stewardship code either has kind of an April delivery or an October delivery. And given that we're almost at April, I think October would definitely be more sensible to work towards. As we discussed, it is quite an onerous piece of work, so we really need to give plenty of time. And we also need to factor in things like committee approval, first draft reviews and things. And also, you know, we need to give external managers enough time to kind of collect all that data and send it across. So I've just put some kind of key timelines. It can be relatively rough with an end date of October for delivery. And LDP Central will also be able to review 2 drafts in total. And as we've noted, we've been through the process ourselves twice, and we've also been through the process with 2 of the other partner funds, which should really help in that as well. So yeah, just happy to take any questions on the stewardship code and kind of the timelines and things.
Simon?
Yeah, sorry, this may have come up before. FRC, who are they? Who? Financial Reporting Council, but who are they?
So they regulate the kind of financial reporting and accountancy standards in the UK. And they've had a stewardship code in place for a long time, but it was a little bit of a kind of a tick box exercise. There was no pass or fail element to it. You either did a report or you didn't, and in the last couple of years they've beefed that up to make it more output focused, more useful stakeholders.
I did try and look up. I did look them up, and you know, we know sort of like who the government or the Bank of England set up as the benchmarking or the stewardship or even the FSC with the wood or the timber. But I mean, FRC, so it's a body of the Chartered Accounting Association, is it? Or
yeah, it's more of a financial reporting council, so it's more of a regulator standard setter for.
So it's government.
Yeah, it's I think it's a offshoot of government. Yeah, it's got some kind of semi-autonomous government status associated with it.
Okay, I mean, there's just a lot of these group. I mean, the latest one I understand is the Value Reporting Foundation. I don't know if you've come across them. So I think that's a conglomeration of a whole raft of other reporting bodies, which has recently emerged. And I mean, it's quite difficult to put your finger on which one of these reporting associations or bodies is the one we should be hitching our cart to.
Yeah, I think it would be very hard not to adopt the FRC. It is the kind of standard methodology for investors and asset owners to report to their stakeholders on their stewardship approaches, and it used to be very much focused on how you might engage with an investee company. It's now much more focused on how you steward the assets under your management as well. So it is very widely adopted. We expect all our managers to have achieved the required status. Most of the pools have done it. Most of the large asset owners have done it, and would also expect their external managers to have done it.
Okay, thank you.
Okay, any more questions? No. Should we move on to the ESG Data Tool, please?
Yeah, absolutely. So we're looking at, sorry, on page 8, if we just begin there. So we're looking to procure a ESG data tool, really just to identify the kind of environmental, social and governance risks and also opportunities of investments at both a stock and portfolio level. So as we're currently in the procurement, I can give you some details. So the service, we're expecting it to cover both equities, listed equities and corporate fixed income. The data and analysis is expected to include things like ESG stock ratings, comparative scoring on kind of material ESG risks, a portfolio level tool, and then also kind of qualitative ESG research to provide kind of an underlying context. So the tool will be used for both proactive monitoring of funds and for reporting on ESG characteristics of the LGPS central funds, and the potential to create or to incorporate into the quarterly reporting. We also would really like to kind of look at perhaps having an annual reporting format similar to what we do with the climate risk reports, where we produce an annual report that kind of comes a little bit away from the climate change aspect and covers, kind of more of the wider ESG risks that the fund is facing. So the tool will also help us kind of challenge external managers as well. So on their stewardship, on their engagement activities and things, and on the prioritization of stewardship resource. So just with the procurement, we have begun the procurement. It is expected to take several months. So we'll be able to give you a little bit more detail on kind of what the tool will be able to do at that point. But we have on page 9 kind of produced, kind of a use case, what we could be using this for. So just on page 9 of the slides, there's several kind of uses. So on the illustrations we have, we could be reporting regularly on the ESG profile of funds. So kind of like in bar charts and figures, similar to the climate risk report, we can see a trend. And we're hoping also to pull out kind of key, E scores or S scores, so things like human rights, for example. We could really kind of hone in on that and see, how the fund is doing, where are the laggards, and what can be done there. So there's a lot that can be done there. We can also do like kind of stock level analysis, which can really feed into the kind of climate stewardship plan, and also maybe a stewardship plan that covers broader ESG issues. So we talked about Glencore. With this type of tool, we can then look at Glencore, see what kind of research has happened, what's happened in the last few years with that company. So really, there's many functions that we can have with a tool like this, and it's definitely something that we will be bringing again to partner funds to get your input on kind of what you would like from it, what would be best for you and what you'd find most useful in terms of kind of identifying material risks and things. So super happy to take any questions on this.
Any questions? No. Okay. I think should we move on?
Sorry, Chair,
yes,
Roger,
go on. Yes.
Quick one. I was going to bring it up at the end, but I'll bring it up now. These papers are marked confidential. Had a note from Shropshire Council asking us not to circulate them, but we are in open session, so they are now public papers.
Yeah.
Okay.
Yeah.
Fine.
Yeah.
But
Yeah.
I see it's marked confidential on the side of the papers, and as I say, we had a memo from Shropshire Council saying not to circulate these. There is one exempt paper included in that bunch. Okay, but these are now public papers.
Yeah.
Okay, thank you. Sorry, Jim.
Okay, any other questions? No? Well, let's move on to net zero, the net zero update, please.
Yeah, sure. So I'm going to have my slides up in front of me, so I won't see hands or anything like that. So, but please do stop me as I go through this if you have any questions, or we can pick them up at the end. But so you're absolutely right. We do need to focus on short-term targets. And this first chart on page 11 really illustrates the fact that we can't allow companies to carry on with business as usual, and then when they get to 2035, 2040. Have a mad rush to get to net zero, because this whole problem that we have is around cumulative emissions. So it's the amount of emissions that we throw up into the atmosphere. So we need to see early adoption of decarbonisation strategies and the results of those happening between now and 2030. And those lines there, the green line there suggests the appropriate trajectory, and the red line suggests an inappropriate trajectory. They both get you to net zero in 2050, but they're not equal in terms of what we're trying to actually achieve here. And just a point, what in terms of our engagement program and what we do with the companies in the portfolio, we're really trying to bring about something that we would refer to as organic decarbonisation. So not trying to sell our high emitting companies necessarily to other investors. That doesn't necessarily have much impact on the real world emissions. It may make our portfolios more carbon efficient, but it doesn't necessarily influence the amount of carbon that's being emitted. And then just the other thing to mention as well is this is absolutely a conversation around absolute emissions. We've traditionally, with other investors, focused on carbon intensity, which is the carbon emissions of a business divided by the revenue. So the carbon intensity of a company is a product of both its emissions and its revenue. So if revenue goes up and emissions stay the same, the carbon intensity will go down, even though the emissions haven't gone down. So that's why we need to track absolute emissions, and there'll be an increased focus on that in our climate risk monitoring service going forward. And we will also apportion those absolute emissions that the underlying companies have to our portfolios using the weight in the portfolio, so that we can also monitor the ongoing performance of our portfolios through the lens of absolute emissions. And that's something we're working on at the moment, calculating that and setting some parameters around that. And we can link all this through to our engagement program, which is a key to make sure that this is linked, reported and precise in terms of what we're actually trying to achieve with the portfolios and with the companies within it, so that we can report precisely around that. So if we move on to slide 12, and that just talks a little bit more detail about what we expect to see in terms of net zero targets from corporations. And that's absolutely critical that we get this right now, that the companies that we invest in have credible net zero targets, because not all net zero targets are equal in terms of what they're going to realise. And this is a key part of the engagement with companies. It's a key part of the analysis that we need to do on our portfolios, on the companies within the portfolio, and the challenge that we give to our external managers on their delivery on our expectations. In the absence of credible targets, it's very unlikely that a company is going to decarbonise at the rate required. So just some key elements of what a good target looks like. So it must have short-term targets in it, 2030 targets, and they must be aligned to the net zero trajectory. They must be expressed in absolute emissions and not just carbon intensity, because we know that we could miss a trick there if we just track carbon intensity. They must have scope 3 in there. We can't just focus on scope 1 and 2 emissions. They must be holistic and accurate, so that they must cover the whole of the business and not just certain parts of the business, certain regions or certain business units. They must be for the whole of the business, and they must be accurately reported. And that's partly an engagement that we're involved with the Church of England and Brunel in terms of reviewing the carbon emissions reporting of corporates and making sure that they're as accurate as they can be. And then we don't want to see offsetting used until all of the decarbonisation potential has been achieved by a company. So certain sectors, they will have some residual emissions at the end, and offsetting will be required, but as owners of those companies will kick the tires quite hard in terms of how they use offsets. They should be purchased on a regulated exchange so that they contribute to the price of carbon, and also that the offsets must be in perpetuity. They can't be offsetting emissions that for 5 or 10 years. This has to be, we're talking in terms of hundreds of years here. And the company must have demonstrated some decarbonisation potential. So it's no good having a target if there's absolutely no prospect of those targets being achieved or realised. And one thing that we will do as well is monitor their reliance on tech. So that chart that I showed you, companies waiting around till 2040 in the hope that some technology is going to come along and allow them to achieve a net zero status. We need to understand how realistic their expectations about technology are and challenge them on that through our engagements. So moving on to slide 13, we're working with an organisation that's led by an academic at University College Dublin, who has developed, through the application of artificial intelligence, a process for assessing the net zero targets of any entity. So this applies for governments, corporates, including anybody who's issued fixed income securities, equities, and private markets. And it goes through a 6-point scale, which I've outlined in the slide before. I won't repeat that, but it's cumulative, so you can only be scored on your GHG removals and your GHG sequestration, i.e. your offsetting, if you've set these targets in place first and are demonstrating potential on that. So moving on to slide 14, we've run a few companies through that, and this gives you the output. So this company, NL, which is I think it's Italian, but it's a utilities company, so electricity and gas. This tells us that they've, in terms of their net zero targets, they've achieved the first 4 of these requirements, but they haven't yet got to the offsetting. And so through this analytical tool, this gives us a very clear focus in terms of our engagements on what we need to speak to the company on and what the ask is. And NL scores quite well, but not surprisingly, there are a lot of companies in the benchmark that don't score so well. So, but it's important that we understand the reality of where we are, and try and identify greenwashing in net zero targeting. So moving on to slide 15, this allows us to do portfolio level analysis, so we can break it down by sector and understand the average score in terms of what the companies in the portfolio are achieving in respect of their targets. And just to reiterate on slide 16, you know, the 50% reduction by 2030, which is the middle circle there, works out to about 7.6% per annum every year. And that's something that we will track in terms of our portfolio and the performance of the companies, with the overall objective of achieving net zero by 2050 in alignment with Paris, Glasgow, and most countries around the world. And so key focus at the moment is establishing these metrics in our climate risk monitoring service reports, and that will be you know, a conduit for which we can report on progress and the trajectory, and update you on our engagements and how they link through to the net zero objective and targets that we've set. The 3-year reviews that are ongoing at the moment with external managers are also going to be a key part of where we establish our expectations, and if necessary, put side letters into the mandates if that's required, to say that, you know, this is a hard requirement in how the mandate is going to be managed going forward. So I'll pause there if there's any questions on that. I know that was quite a quick run through, so happy to pick up on any points there.
Simon.
Yeah, very quickly. On the summary, going forward, is it possible to put any real measurables there? It's just that, you know, 7% per annum of what to what is,
yeah,
really help. I know you were talking about metrics, but going forward, it'd really help if you could put, we've reduced it from, I don't know, 115 to 112 or something, whatever it is.
Yeah, sure. So the base year for that, Simon, will be 2019, which was when we started reporting carbon in 2020. It was based on 2019 data, which is helpful because it's pre-COVID. So that'll be the base year, and we'll measure absolute emissions, so the total emissions that companies are emitting, and we'll apportion that to our portfolio by using this concept called financed emissions, whereby we work out how much of the company's absolute emissions we own as an investor. So if we own 1% of the company, we own 1% of their absolute emissions, and that's how we can measure the trajectory of the portfolios going forward towards the 2030 target and the year-on-year performance. And this will get reviewed annually. In 3 years' time, we'll take a step back and say, right, okay, is 2050 still appropriate? Has the international community set different? Remember, it's a 2050 or at the latest target. So this will remain constantly under review in terms of its appropriateness.
Caroline, please.
Thank you. I mean, I think the commitments are set out, and I think they're good, and I think they reflect conversations we've previously had in this room. I'm curious about the 50% by 2030 and then breaking that down to the 7.6% per annum, given that, well, two things. At the last meeting, we did have quite a long discussion about the very short term, i.e., sort of 18 months, 2 years, and the need to really front load emissions, emission reductions. And also, I'm just wondering, is this the sort of, I know the 2050 still exists, but the latest IPCC report does actually stress the need for much greater urgency and much more action in the next couple of years. And I'm not sure this, for me, reflects that latest thinking.
Well, the asset allocation decisions that you've made in terms of transferring into lower carbon funds will immediately realise a reduction in your absolute emissions and the carbon intensity of your portfolios, which we will measure through the climate risk monitoring service for you. I take your point that there is a high degree of urgency with this now, but 7.6% is the target that extrapolates out to that 50% reduction by 2030 and the net zero 2050 target. Now, I'm not suggesting that that's going to be a limit on what we will try and achieve and what we will encourage companies to do, but it is a measurement against those longer term targets. And I think we, have to recognise how challenging this is going to be for corporates in a number of different sectors. There's no getting away from that, and it's why we haven't seen as much progress as we would have liked to have seen at this point.
Sorry, so where has the 50% by 2030 come from?
So if you work out the total carbon budget, which is about 400 billion tonnes of CO2 equivalent between, that's our carbon budget, what we've got left to use before, if we want to limit climate change to 1.5 degrees, and that works out, and we need to not use all that up in the first 9 years of that period. So if we work out a business as usual how much carbon we're emitting, we would use it all up by 2030. So we need to half what we're actually emitting between now and 2030 in order to limit total emissions by 2050 by that carbon budget of 400 billion tonnes.
So, sorry, I suppose I'm still not clear. I guess why half? Why not be again that kind of ambition? Why not 60%? Why not 70%? So I think for me it's just that issue around we have to, and we've said this at previous meetings, we do have to really front load. That curve needs to be a very steep downward slope in the early years of this process if we are going to get anywhere near net zero. All the current analysis and predictions shows us, not just us as our pension fund, but globally overshooting net zero by 2050, and so that's why the latest IPCC report stressed the need for urgency. And I just think, maybe you put this together, that was in February. I appreciate this report may not reflect that latest thinking, but we do need to ensure that we're keeping pace with the latest information coming out, and reflecting that urgency, reflecting the latest science in our target setting. And I'd like to see us be much more ambitious than 50% by 2030.
Okay.
I think, like I say, it's not an upper limit and it will be reviewed, but it is in line with what was agreed at Paris and Glasgow and what international governments around the world have agreed to. And I think we need to recognise that how challenging it actually is. Now, if we go to companies and suggest a different target to the one that their governments are expecting them to achieve and the majority of the investment community are expecting them to achieve, then that's going to be a real challenge in terms of trying to realise that. Now, we're not suggesting that they shouldn't go faster than that, and some are, and we will encourage that. But overall, in terms of, the target of 1.5 degree is based in science. The numbers have been extrapolated and worked back from that. We're already at 1.1 level of global warming has already been realised. So, that doesn't leave us much scope in terms of where we can go from here. So 1.5 is a challenging target, and if these numbers work out and this trajectory is achieved, that should be enough. There are challenges associated with modelling this, and there's a certain amount of inaccuracy anyway around all of this and what the implications of 1.5 might be, and whether we actually realise that in reality rather than on paper, which is a key consideration, I think, here. But I take your point that action needs to happen now and be front-loaded and not back-loaded.
Okay, thank you. Should we move on to the last part of the slide, please?
Yeah, sure. I don't know whether Justin, you want to just jump in here and give an update on Shropshire's position on Russia before I talk about LGPS Central.
Yeah, that's fine. So a number of partner funds within LGPS Central have made a public statement on Russia and Ukraine, and obviously we're part of that, so we're supporting LGPS Central statement. So as I put in my investment monitoring report later on today, Shropshire County Pension Fund exposure is 0 to Russia. but we do strongly support the statement that LGPS Central are making on behalf of all partner funds. So it's something that we'll be putting on our website. So I just wanted to say that before the statement comes out from LGPS Central.
Yes, so it's probably best if I go straight to our statement, because when I put this slide together, we hadn't formally agreed a statement with all the partner funds yet. So the slide is kind of superseded by what's happened since. So if I just read this out, and it is available on our website. So at LGPS Central, we have taken the decision to instruct our external managers not to increase our existing exposures to Russia and Belarus, and are engaging with them to bring about our exit from our existing Russian exposures, subject to the challenges posed by market suspensions and the sanctions regime imposed by the international community. Our fiduciary responsibility remains at the forefront of our deliberations. The likely event of reduced transparency and weakened governance in Russian corporates raises serious ESG concerns and compromises our ability and the ability of our managers to analyse Russian stocks and bonds in the holistic manner expected of responsible investors. We have also undertaken to review our portfolios to identify indirect exposures to Russia and feed these insights into our engagement, voting and ongoing discussions with our external managers. We stand with others who are calling for a swift and peaceful end to the conflict, but nevertheless recognise that any resolution may take time and result in a prolonged period of uncertainty. We will continue to closely monitor the situation in Ukraine and will review our position as and when events take a substantively different turn and the isolation of the Russian economy is deemed no longer necessary. I'm happy to take any questions on that.
Yes, so Brian.
Just it is stated that the Shropshire Council Pension Fund has no exposure to Russia. Can you indicate what exposure to Russian and Ukrainian stocks the actual LGPS fund has?
Yeah, we've done that work. I don't have those numbers to hand, but I'm sure we can share those with you via Justin. We have some exposure, obviously, in our passive portfolios because they hold the whole of the benchmark. There's no active decisions there, so they have some Russian holdings in there. Our corporate bonds as well have some exposure to Russian corporates. And in our emerging market portfolio, there is some exposure to Russia as well, as you would expect. Then it's not an enormous exposure, it's relatively small, but there are some holdings in there. Most of those stocks now are either the subject of sanctions or we can't trade them anyway because the Moscow Stock Exchange has suspended trading. There are some stocks traded on London, but again, it's very hard to trade in those because of illiquidity and lack of a counterparty. As you all probably have read, the benchmarks have written, most of the benchmark providers, MSCI and FTSE, etc., S&P have written the holdings down to zero in terms of value because they can't be traded. There's no price discovery. You don't know what the shares can be traded at, so they have no value. They've been written down. If there are some traded on the London Stock Exchange, for example, the last price has been used to value them, which we think is probably the most accurate way of doing it. So that's the current. I mean, we can give you details on the weightings and the amounts.
Yes, Brian. Yes.
Presumably they can't be traded because nobody in their right mind would want to buy shares.
Well, it's a very interesting point, and this was one of the things that we were very concerned about. These stocks have an intrinsic value in terms of the fundamentals of the business. So how much, whatever it is they make or sell, oil and gas, coal, whatever, steel, whatever it is they're making, they're still doing business with certain countries around the world and certain partners. So they still have an intrinsic value. Now, what we didn't want to see was our managers going around sweeping up those cheap stocks in a hope of making a quick buck as and when this situation is resolved and trading resumes. We didn't feel like that was appropriate, and we didn't think our members would feel that was appropriate. So you're right. At the moment, there's not much going on, but the other consideration is that when you do sell these off, that they're purchased by some Russian oligarch or somebody else who might sit on them and end up making quite a lot of money. And in the long term, that could be counterproductive as well in terms of what we're trying to achieve here, or what international governments are trying to achieve. So there are a number of considerations there. Fiduciary responsibility suggests that you buy things when they're cheap, but this is a unique situation. So normal rules don't apply.
Okay, thanks, Rob. Roger, you wanted to ask a question? Yes.
Thank you, Chairman. Did refer to it obliquely early on in the meeting, and that is, I noticed the bullet points on your slide 18 and where to draw the line. Some of the companies that we have shares in are continuing to trade with Russia. One of the biggest names, of course, and we've referred to it later on today, was Glencore. The press over the weekend confirmed that they are filling their tankers with Russia oil in order to take it away and transport it and sell it on the market or whichever. I note the government has said 12 months or some time to withdraw from it, but what pressure are we exerting on companies like Glencore to stop trading? Companies like BP are to be congratulated on what they are saying publicly, but not all companies are saying that. Some are staying quiet. So where is the line to draw? What pressures are we, as a substantive shareholder in some of these companies, doing to ensure that they are complying with what we, you, the shareholders, want them to do?
Yeah, so we're the lead engager with Glencore on the Climate Action 100, so we do have some influence there. And already you will have seen the Church of England engaged with Shell. Shell withdrew from Russia, but then ended up buying some cheap Russian oil. And after pressure from investors and conversations with investors, they've decided that that was inappropriate and they won't do that again. And the Church of England are engaging with Total, who have also taken a position that they won't withdraw from Russia. So it is something that we will engage with them on. We think it's an appropriate approach for them to take based on the international sanctions regime. Now we have engagement meetings coming up with Glencore. Our focus at the moment has been on trying to understand what our indirect exposures are to Russia, and particularly any companies who might be either indirectly or directly supporting the Russian war machine. For example, we noted a company, a truck company that has a small arm that sells military vehicles, that sold some vehicles to Russia. They stopped doing that after the Crimea invasion, but some of these vehicles are still being used as were used in the ground invasion. So we've been engaging with the manager on that quite closely. So that's the first port of call. What direct or indirect even exposure to the actual conflict do we have? And then we'll broaden that out to a list of companies that we think are perhaps not acting appropriately in terms of continuing with their Russian activities. And I think we saw that with Coca-Cola as well. They initially said that they weren't going to withdraw, and then after a groundswell of public opinion, they decided that they would. So that will be something that we will engage with them on, and we have, I think, engagement meetings with Glencore coming up where this will be one of the topics under discussion.
Okay, thank you very much. One thing I think would be appropriate for us to do as a committee, and that is to actually endorse the LGPS central statement that Patrick read out about 5 or 6 minutes ago. So are we happy as a committee to endorse this statement, because many other pension funds are actually doing the same thing, and I think it's appropriate that Shropshire County Pension Fund should do the same. So I'd like to propose that this committee endorses this statement. Can I have a seconder, please? Roger, and everybody in favour? Okay, that's unanimous. Thank you very much indeed. And thank you very much, Patrick and Laura, for the 2 presentations. Thank you, very useful.
Thank you.
Thank you.
Okay, members, we'll move on to item 8 now, which is corporate governance monitoring, and Justin will take us through this particular paper item 8. Thank you,
Sure.
Justin.
Thank you, Chair. Yeah, so this is the quarterly corporate governance report that members receive each quarter. It provides a lot of detail in the appendices to the report about the voting and engagement from BMO, LGPS Central and Legal in General. Obviously, we've had updates today from LGPS Central. We've had 2 climate risk reports. We've had our second TCFD report produced today as well. We're already a signatory to the Stewardship Code. We're planning to become a signatory to the new code by the 31st of October, as discussed today. We have had several presentations from BMO and Legal in General. I appreciate some members are new to the committee, so if you'd like BMO or Legal in General to come and present to committee again about their engagement activities and the outcomes, I can arrange that. So happy to take any questions on the report, but just to note.
Okay, any questions? No, in that case, we'll just recommendations to note the report. So can I have a proposer, please? Yeah. Brian, yeah, second then. Simon, and everybody in favour. Thank you very much. Thank you, Justin, for that. We'll now move on to item now. The strategic allocation and implementation update, and Louis and Colin Cartwright will present this to us. Thank you, Louis.
Thank you. Just quickly introduced to the committee, Colin Cartwright. He has replaced Emily Maguire, who has left Aon. Colin will cover the next item covering inflation, Ukraine and kind of the market outlook. I'll provide the quick update on the strategic asset allocation and implementation, which I believe is a PDF that members have.
Yes, we have.
Okay. So on page 2 of that, we actually looked at the investment strategy in a lot of detail, concluding last year. The objectives that we talked about at that time, and I think will still apply going into this valuation year, is that we're looking to achieve a funding level of around 100%. That is the assets being the same level as the present value of the liabilities. At the last valuation, we were around 94% in 2019. Last time we checked in December 2020, we were looking close to that 100%. However, that was based on old assumptions. Assets have actually been pretty strong, so we're hopefully in a strong position, although you'll all be reading about market volatility so far this year. Furthermore, one of the things that the actuary raised last time we spoke to them is that we need to think about expectation of returns going forward. And actually, because we've enjoyed very strong returns, expectations of returns going forward are lower. That means a lower discount rate, which puts a higher present value on your liabilities. So one of the key objectives when we looked at the investment strategy last time round is we needed to keep the returns up, increase the expected returns, in order to minimise higher costs, the cost of future accrual particularly. However, high returns means risk. So one of the things that we're looking to do at last time round was how we manage that investment risk as best we can. And I expect those 2 points, keeping returns up whilst managing risk, to be a focus this year when we look at investment strategy as well. So on page 3 is what we got to as a committee in terms of how we're going to achieve those goals, slightly increase expected returns and manage risk. And we do that by allocating our assets across these different asset classes shown here. The main allocation is to global equity markets, 50%. So over the long term, we expect that to be the key driver of returns of the pension scheme. We're expecting very roughly about 6% per annum from equities over the 10-year, over a long-term time period. However, because it's such a large allocation, and as we know equity markets are volatile, that is our key risk. And I'll come on to how we're protecting from that. Effectively, we've got some equity protection, which we'll talk about later, and we've got diversification across other asset classes, which we show there. We're also aware, and we've spoken quite a lot about this, about some of the climate and environmental social governance risks. We're taking steps within our equity allocation, which we've referenced, in terms of moving about 10% of our equities out of UK into sustainable equity, and moving our passive, which is about 60% of our equities, out of a global FTSE tracker to one that is targeting the low carbon transition, and actually results, as I said, in a very large drop in our carbon footprint straight away. In terms of diversification, one of the key components of our diversification away from equities is the absolute return element. So this is looking for assets that have a low correlation to equities. So when equity markets are falling, are providing us hopefully with some level of protection. So for the example, when we talked about training, hedge funds or absolute return bonds use active manager skill to protect us when markets are falling. And then there are other markets like the insurance-linked securities market that are uncorrelated in their returns from the global equity markets. So this is a really important part of our strategy in providing something different to what we're doing with equities. LGPS Central are working on a solution here. We are working closely with them. The other assets are property, which is a real asset, offers some inflation protection and diversification. Aberdeen, our manager there, are actually helping us get back up to our 5% allocation. They found some opportunities. Illiquid growth, 12.5%. That is private equity and infrastructure, roughly half and half each. At the moment, we're overweight to private equity because those assets have done very, very well, but that will run off through time. We are increasing our commitment to infrastructure because the private equity assets will run off, and a small top up on private equity. Illiquid credit is effectively lending to kind of mid-sized companies that can't access the public corporate bond markets. It is illiquid in that it's like private equity and infrastructure. Your capital is locked up for a long time, in this case kind of 5 to 8 years. However, you got to pick up in income or return versus what you would get in public markets. We've got 120 million commitment made to LGPS Central in this area that will take some time to draw down. And then the remaining allocation in gilts, we're expecting to reduce as we increase particularly the private credit allocation. Finally, in the future, so we're about to have a valuation at end March. It's likely we will have similar goals in terms of maintaining return and reducing risk. And I think Colin's about to come on to kind of some of the risks, and that there is a clear risk of high inflation, high and long-lasting inflation to the scheme. Your liabilities, your pension payments are inflation linked, and on the asset side, if inflation's high and long-lived, that is going to hit economic demand and prospects. So that there is clear high risks of inflation at the moment to the fund. Having said that, we're in a pretty good place because equity markets have had a really good run the last 10 years or so. However, we shouldn't be expecting the last 10 years to replicate going forward. Responsible investment and how we're achieving those net zero goals will also be part of when we look at investment strategy as well. Is there any questions?
Roger Bartley, did you want to come in?
Just a small point, actually, Chair. I think when we're presenting the strategic asset allocation, we should actually show the degree of protection on the equity position.
Yeah. Okay. Yeah. Fair comment, Roger. I think so. We're coming to that later. I think we're protecting about with that 50% in equities, about 30% of that is protected.
Yeah.
Are there any questions, Simon?
Yeah, if I may, absolute return, has that increased from the previous strategy? I mean, it's a bit of a vague description. I mean, it seems to be sort of we put that money in hedge funds. I think I picked up. Is that what does it mean? Can you just go over what absolute return is, and have we increased the allocation to absolute return, whatever that is?
So we have not increase the allocation to absolute return. And actually, I think a part of our review, if you like, this time round is going to look at that in more detail, I think, because we're about to be switching from our own managers, if you like, in that absolute return bucket to ones chosen by LGPS Central. So that's worthy of, as it's quite a major change, quite a big part of our strategy, that is going to be worthy of review. Within that bucket, if you like, it's a bit of a catch-all for everything else that doesn't fit into it. But the aim of that is kind of hopefully described in the absolute return. It is aiming to deliver returns that are uncorrelated to, you know, the markets that you're using elsewhere in the strategy. And I think the key market you're using is equity markets. So uncorrelated or a low correlation to equity markets. And the examples, how you achieve that, there are some markets that are uncorrelated to equity markets. So gold, for example, has a low or negative correlation to equity markets. Insurance-linked securities, which you have an allocation to currently, is uncorrelated. You would expect that to have a very low correlation to equity markets. Those are markets that are absolute return, if you like, in this definition. You have managers that are absolute return that derive their returns from skill rather than markets, and that's hedge funds, which we have an allocation to currently, and absolute return bonds.
Yeah, okay, I get that.
Okay, thanks. Any other questions? No. Okay, thanks, Louis. Should we move on to the impact on financial markets?
Thank you, everyone. Yeah, so nice to meet you all for the first time. As Louis said, my name's Colin. I've been at Aon for 20 years and working with investment on pension funds, and I'm picking up from Emily as she's moved on from Aon. So in the pack is some slides that cover the market update in 2022. There's been quite a lot going on. I'm not going to talk necessarily to the slides, but give an overview of what's been happening. So you heard from Justin and from Central earlier on, you know, direct exposure to Russia. So that's directly on the fund. The much significant impact for the fund as a whole is what it means for wider financial markets and what it means for wider global economy. So I'm going to touch on
Chair, do you think we could ask to take the video off? That might be better.
Yes, okay. Colin, could you take your video off, or we're having trouble hearing you?
Maybe Louis can cover it.
This year, central and inflation now there is energy price issue.
Yeah. Louis, would you be able to cover this item if we're having technical problems?
Yeah, Colin, you're breaking up massively. So I think the kind of key point that we want to get across, I know there's been a lot of focus on Russia, Ukraine. Actually, what's been happening to markets, the concern in markets is all around inflation. And what was happening actually to markets, and markets were going down so far this year before the invasion. And that's a result of very high inflationary environment we find ourselves in. You know, we're expecting CPI to hit about 8% in April and not come down for a year or so. What Ukraine does is that it has an impact in terms of energy prices, such that there's even more uncertainty about when inflation will come down. And as I said, high inflation is dangerous for the scheme in two ways. One, your liabilities are inflation linked. And two, the impact it has on markets. So, you know, the ability of companies to pass on inflation costs and then the impact ultimately that that has on demand, and ultimately, you know, whether that starts reducing demand and we go into a recessionary environment. So a high inflation and recessionary environment is very bad for scheme. We don't think that's not our core, if you like, expectation. Our core expectation is that inflation comes down kind of around April, kind of this time next year, not to the Bank of England's target of 3%, but of 2%, but closer to that, down below 3%. That's our core assumption. That's the Bank of England's core assumption, and that's what the market is thinking. However, particularly because what is happening in Russia and Ukraine, and therefore energy and commodity prices, there is huge uncertainty about that. So normally we might have a core assumption and place quite a high probability around that. We cannot place a high probability around that. There's some you know, potentially quite likely scenarios where inflation is higher for longer and does absolutely start damaging UK economy and the global economy, which is a bad environment for risk assets. So, you know, the inflation thing is the key thing. The Russia, Ukraine, as we've said, in terms of market exposure, is pretty tiny. The impact it has on inflation, and the other side effect of that is also what central banks are trying to do in terms of raising interest rates. Very difficult environment for central banks, in that they've got inflation is massively overshooting. The normal things to do is raise rates. However, if they've also the Bank of England less explicitly so, but they clearly have one eye on the economy as well, and therefore they're not, you know, looking to raise rates as maybe as quickly as they should be doing.
Brian, do you want to ask your question?
There's so much uncertainty about at the moment that I wonder what effect this is going to have on our triennial review, which is due, I think, this coming month or very shortly. Will this, in fact, will that review properly reflect the longer term financial situation of the fund?
Yeah, so there's some key things how it's going to affect it. So ultimately we're going to have a snapshot of your assets at end March. And your assets have been, you know, bear in mind your assets have actually been doing very, very well for a number of years. So yeah, they will have slipped back somewhat since the start of this year. They've actually they were down, markets were down about 10%. They're actually coming back again the last week or so. So, you know, we've got a couple of weeks left to go. So but you know, you've also got the protection in place for some of your equities. So your assets is one thing to kind of bear in mind. The other things to bear in mind is your actuaries' inflation expectations. And I would expect, you know, that what you care about isn't just inflation. This is why, you know, inflation over a year or two is not too bad for the scheme. We can cope with that. But if long-term inflation is expected to be higher, that does start to get painful. And then the other thing that I've mentioned is that your expected return on assets is going to be lower. We've enjoyed good returns. The environment going forward is going to be harder for equities and risk assets to get those same level of returns. So lower returns.
Okay, thank you.
I think Louis has summarised the situation very well. I think one of the questions that we try to ask ourselves is where might markets have got current analysis wrong, and I suspect that although inflation will fall at what we call this headline level, underlying inflation will be stable to up, which is not a good thing, and this is potentially over the longer term. And the reaction to that by central banks, and particularly by the Bank of England, will probably be to raise interest rates more than is currently priced in. So those are the key risks. These inflation picking up and to some extent growth weakening are very, very challenging environments for markets, but particularly for equities.
Okay. Well, thank you very much for that. We'll move on, I think, to item 11, the Pensions Administration Monitoring Report, and that is over to Debbie, please.
Thank you, Chair. There's a few appendices today with the administration report. We've got the performance charts that we're used to seeing.
Maybe.
So, oh, thank you, Councillor. Thank you. A few appendices today with these reports. We've got the performance chart, an update on the fund logo and methods of communication, and then 3 policies that we've updated that we'll be asking for approval or comments on, and those are appendices C, the training plan, the governance compliance statement at D, and then the reporting breaches policy at E. Going through the report, just wanted to point out performance and team update, very much focused currently on getting people into the vacancies, but also working on ensuring that as much of the data is at the correct status to feed into the valuation that we've just been talking about before. So to ensure that the liabilities are as accurate as we possibly can be going into the 2022 valuation outcome. Communication and governance, we're still working on ensuring that as many people use the pensions online portal. We've been communicating with our employers, reminding them about how to deal with absences and ensuring that they're updating us to ensure the records are correct for our members. The employee contribution bands are going to increase in April, so to ensure that they're collecting the right contributions, updated them on those. There's a notice at number 11 that in future the cybersecurity has all been moved into the exempt governance paper. Branding guidelines have been not been updated. We've actually produced some, which is part of the branding update. We've just modernised the logo to ensure that it's easier to use and viewable on our documents, on our website, to help with accessibility. So a lot of everything that's driven at the moment on the fund is to ensure that we're keeping up to date to make sure that everything's accessible for as many people as possible. The training policy is updated. You'll see it was last a formal update back in December 2020. This includes how we're going to approach training for officers, board and committee. A big commitment. We're using and basing it around the code of practice and knowledge and skills from CIPFA. And we've always done a lot of training. We use the pensions regulator training modules as a base to ensure that everybody's got their knowledge and skills across investment administration and pensions as a whole. But what we need to do is ensure that that's all being captured and that we can document and show how the committee, the board and officers are going to tick off all of the boxes for the Scheme Advisory Board's Good Governance Review and insurance that we are coming up with all the pensions regulator codes of practice. The governance compliance statement has been updated with around the climate change strategy and building in Tcfd reports. So that's at Appendix D. Appendix E, the breaches policy, just needed a few tweaks really to ensure that it was complying with the guidance from the pensions regulator. And we, at point 17 there, you'll see we have now actually been able to join fully the scans pledge to ensure that we're keeping our members as safe as possible. Dashboard is still ticking on in the background. There's just been a consultation on the draft regulations that they've put out. The officer response heavily supported the local government association's response that went into great detail on this. Sadly, the report was too early to feed that into it. But the main area I think the Pensions Committee to be aware of, I think we pushed back and asked them to reconsider the date of onboarding for LGPS schemes, which should be April 2024. But there is an awful lot of work coming our way to actually bring all of the fund and the benefits for our members in line with the Mackay judgment in between that time. So we've just sort of asked them to reconsider that because it may be putting too much work onto the amount of resource we've got to sort out these issues. And I'm happy to take any questions on any of those. It's quite a long report, but happy to take any questions, Chair.
Roger Evans. Thank you, Chairman. And right at the start of the meeting, there's a reference to it, and I see on page 173 about Act 9 of 22 at 50, an annual meeting is held each year to which all employers and scheme members are invited. Now the difficulty with COVID, but is there a meeting being organised to be looked at so that the contributors, pensioners can actually take part? Because that's what I assume that refers to.
We will be for this year if COVID restrictions all allow. Then at the moment what we've ensured is that all of the website is completely up to date with all of the information that they're able to get. We communicate with them via emails. We make sure that the information is on the website, and as far as I'm aware, if we can do a meeting this year, we will be arranging one.
Yep, right. I think with modern communications like we have, even if it isn't in person, it could be run as per something like this. There are some, and I know there's many members, but how many will come in, I don't know. But we haven't had a meeting, I don't think, for some time. We did refer to it to the last meeting and what members wanted from this committee. And I would have thought some of that needed to be tested. The employers had a discussion, if I remember from the last meeting, but the employees or the members have never been involved. And I would urge that something is tried to engage with the members so that we can all see what the members would want us to put in as a policy, and leave the experts then to define how they're going to deliver that policy.
Yeah, noted. We do email them. We collect email addresses for all of our members that actually engage with us electronically. So we are updating them, and everything goes out electronically to those who have logged their email.
Yes, just can I just add to that? Yeah, so obviously, it's in the report and in the minutes last time. So yes, we haven't had a face-to-face meeting for a couple of years because of the restrictions, because of COVID. But all the items and all the information we normally discuss at the AGM have been put on our website, and so the team, is always available to all their scheme members to contact us. So everything that would have been covered over the last 2 years is available on the website and in the public domain. But we will look to reintroduce that as and when we can. We did have the employees meeting. That's when the restrictions eased, so we were allowed to do that. But it's been difficult with regards to the AGM, but all the information is in the public domain and on our website for all scheme members to access as and when they need to, and the team can be contacted at any time, any queries.
Right, Roger. I recognise the difficulties, and I'm not saying I haven't tried and keeping communication. Yes, it is, but I think with the present situation now, and at the last meeting, I was one of those who wanted about fossil fuel coming out of it. It would be, and what was said is that there has been no pressure. My words, or the intimation was that we talked to employers about it, and okay, everybody is content about what is happening. I just wanted to test that opinion among some of the members for it as well as the employers. There was a reference at the last meeting that employers had been asked and contacted and talked with, and their views were carried out yet, but there are the contributors and the pensioners. I would have thought that maybe we need to just gauge the opinion there so that I can be sure that I am reflecting what they would want us to adopt as policies.
Okay.
Sorry, Chair,
Yes.
can I just add, we do communicate, our pensioners still have a newsletter, they have a representative, we've got email boxes set up for the board and for our pensioner representative, and we also send newsletters to our employees as well, so other than the face-to-face meeting, we've ramped up on everything else.
Yes, that's what I wanted to say, that I've met quite a lot of people over the last year and they said how much they enjoy getting the In Touch magazine and seeing all the information in it and getting information.
So thank you for that. Any other, Carolyn?
Yeah, just on the governance, I'm still not quite clear how the forward plan of agenda items is set, how we as committee members can influence that so that we're actually, I suppose, driving forward the agenda rather than being a passenger to the agenda.
In terms of setting the agenda, that's part of what these committee meetings are about. So things can be raised in terms of areas for influence, but in terms of the agenda setting, that's discussed with the chair. So it's about identifying and highlighting those issues. That's how.
So we've had lots of discussions here about those target settings. So is that something we can say? We will actually have a specific agenda item around those very clear. You know, next year we will want to see, in terms of climate risk, for example, our carbon reduction at this level and the year after. So we can actually set those targets rather than it, because I feel a bit like we are, well, let's say passengers on this process rather than really driving it. We talk a lot, but I don't see the substantive change, and that's what I'm trying to get to. Thank you.
Just coming back on that for Chair, there is a lot of business that we have to go through. So therefore, the agenda, there's a lot of the agenda is set automatically. So there's opportunity for training in between times. Training is a very wide term. There's lots of things that could be considered as part of that. There's extended meetings, or there is fitting things into the agenda. The thing we've got to be careful of course, is that we don't say, okay, we'll pick that up and then we spend 5 minutes on it because we've got so much on the agenda. So we've got to get that balance out. But it's basically about raising those things and in between meetings, raising them and asking for, could we have something about this? We can make sure we pick those up businesses.
Thank you.
Okay, well, yes, Simon.
Yeah, so this is a linguistic one actually. 10.1, page 143. What is a monthly deficit payment? I'm sure it's technical. I don't understand.
No, good question. As part of the valuation where you're looking at the assets and liabilities, that comes out as an individual employer contribution rate for their future contributions or building up a future service. If their liabilities were bigger than their assets for each individual employer, because the actuary has to go down to the employer level. So if they were in deficit, we have to we have to collect that sum of money from them. And a good few years ago now, it was decided to come away from adjusting the future contribution rate, because with falling payrolls, then we weren't collecting enough money for when they were in surplus. So that's what we have to do now. So as well as collecting ongoing contributions, we're also collecting any contributions towards lessening each individual employer's deficit.
Brilliant answer, thank you very much.
Ray.
Chair, apologies, Debbie, I was out of the room when you presented most of this document. The really nice training policy, is that new?
No, training, this is an update.
In which case some of it is not actually happening.
Which
something to take up later on?
No, that's why we've revisited it. We're looking at it, and the issue is it's ensuring over the last 2 years from COVID, things have changed. We used to have an annual corporate training day, different things like that. So I think what we're doing on my team at the moment is actually looking at it along with the SIPA guidelines and saying what now needs to be reintroduced. COVID is not an excuse for anything. We've got to get back to not to where we were, but where we now need to be going forward. And I thought that the issue is at the moment, we also need to ensure that everybody on committee is aware of all of the policies. And so all of that's got to be brought back in. So no, a good question. That's why we're doing it, to bring everything.
I've saved the separately.
Yeah, no, it is. There's a big push at the moment from the Scheme Advisory Board and the Pensions Regulator on ensuring, and when the outcome from the Good Governance Review comes out, then there are tweaks going to be from committee, board, officers, designated officers. There's lots of things that are going to be changing. So what we're trying to do is preempt some of that, which is the latest update, and then we'll do another revisit when the outcome is known. But it's refocused on it because everybody's got to get up to speed with exactly what needs to happen.
Thank you.
Thank you.
Thank you. Lindsay.
Oh, well, first of all, Debbie, as a user of your team, I'd like to say thank you. Your team's doing a wonderful job. But on the training, are we going to have any kind of like training from a divestment point of view from people who are more interested in divesting rather than people who are more interested in engaging?
I think that the training, I would say over the last 2 years as a committee, we probably had more training rather than less. So if you remember, a lot of the committee members that were on the committee, we spent a lot of time on the investment strategy. So we had separate investment strategy workshops. We've had virtual training, which obviously we didn't before. So I would say we've upped the training over the last couple of years. All members have got to undertake the TPR module. So I would say we've done more over the last 2 years. There's more to do. As new members come onto the committee, there's a programme of training, but there's a whole host and range of issues that we need to cover with that training. We've just had 18 months training on climate related issues, which covered, a lot of committee members know we went into details on engagement, divestment. We've had experts in to train the committee, give presentations, but there is so much more that we need to focus on as a committee on pensions administration side and pensions investment. So rules, laws, regulations, there's all these TPR modules are there to assist. They cover all the main areas. Climate has been done, for the last, as I said, 18 months, and we made a commitment to continue every quarter to update, every 6 months to produce short and medium term targets. We've every year to produce a climate risk report, every 2 years to do our, update climate strategy. But there is a whole host of training that the committee needs to go through, and officers, and this will identify any gaps that members and officers of the committee have got, and then we'll pick up that at future training sessions in between meetings. But we have had separate investment workshops. We have training at every committee meeting now, when we never used to. We have presentations, so I think we've really increased the amount of training we've done over the last 2 years. And we do adhere to our training policy. There's more to be done, but that will continue over the next 6 to 12 months.
Can I? Yeah. I was just wondering, would it be nice to invite some pension funds that have actually divested and hear about their experiences?
I think I'm quite happy with what we hear about divestment. Our main purpose is investment, not divestment. And we had a long discussion this morning about divestment. It's not as though we don't even consider it, but I don't think I want to attend any training on divestment. I'm happy to attend the training that increases my knowledge of my prime function for which I'm on this committee, which is the investment of the funds to the best advantage of our pensioners.
Okay, thank you, Brian. We've got four recommendations. I think I'd like to sort of move things on. So the recommendations are 3.1, members are asked to accept the position as set out in the report. 3.2, to approve the revised training policy Appendix C. 3.3, to approve the revised governance compliance statement at Appendix D. And 3.4, to approve the review of the breaches policy at Appendix E. I'd like to move those recommendations, and may I have a seconder, please? Simon? Yep. Oh, and everybody in favour? Yep. Okay, thanks very much. I'd like to go through the next item, which is item 12, just before we go into private session, and then I'm proposing that we have a comfort break as once we've moved into private session. So agenda item 12, this is the pension fund treasury strategy, and Justin will kindly present it to us.
You'll have to excuse me because my laptop's just completely died, so I've run out of battery, so I can't get it. So I will run through it.
I wonder if we could get rid of that vision on the screen.
We'll do that during the break, right?
It seems to be dominating the whole.
Big Brother's watching.
Yeah, so a quick run through the pension fund treasury strategy. So this is a report that we have to approve each year as a committee. So this relates to the small cash balances the internal treasury team manage. So as you're aware that the 2.3 billion of the fund is all managed externally. This is the small sum of money, currently around 4 million for the internal treasury team. We need it managed. We need to have a separate strategy from the councils. It does mirror the Shropshire Council's treasury strategy, but we need a separate one for the pension fund as well. So there's a number of recommendations for the committee to approve in that report. I'm obviously happy to take any questions, but it does mirror Shropshire Council's treasury strategy. So happy to take anything.
Simon?
Yeah, happy to support, but 4 million sloshing around in cash just seems quite a large amount to keep in a current account.
It's not cash, it's invested. It's invested in line with Shropshire Council's treasury strategy. So on a daily basis, the internal team monitor the cash position. So at the end of the month, obviously, we're paying there's pension and payroll going through. So we're just making sure we've got the cash available to manage that. But is it?
So liquidity management.
Yeah. So it's invested in money market funds and with highly secure financial institutions, the same as Shropshire Council's investment funds.
Okay. Any other questions? No. Well, we've got a number of recommendations. 2.1, we're asked to delegate authority to the scheme administrator, section 151 officer, to manage the pension fund's day-to-day cash balances. We are asked to approve the pension fund treasury strategy. We are also 2.3 asked to authorise the scheme administrator, section 151 officer, to place deposits in accordance with pension fund's treasury strategy. And 2.4, we are also asked to delegate authority to the scheme administrator, the section 151 officer, to add or remove institutions from the approved lending list and amend cash and period limits as necessary in line with the administrating authority's creditworthiness policy. I'll propose that. We have a seconder. Roger, and everybody in favour? Okay, thank you very much. We will now move to item 13, the exclusion of press and public. Can I have a proposer, please? Motion, Simon, and Brian seconding. All those in favour, please? Thank you very much. So we have now come out of the public session.
I'll just ask for the live event at the end, so if we could just wait for the confirmation.